Chapter summary for the conceptual framework. So a really important chapter that just sets the scene of what international financial reporting standards are all about. It's not a standard in itself, but it contains all of the qualities and characteristics that make a good accounting standard and that the accounting standards are drawn from. First of all, an idea of the fact that it is a framework, and what does a framework actually mean? A framework is a set of accepted principles. It is not rules. So something to be aware of. Because of that, we can apply principles to any given situation rather than having a list of steadfast rules. So this chapter comes up a lot in section A and B as pure knowledge-based questions. It's a case of learning the stuff that's in here and being able to churn it out. A learn and churn chapter. But as I say, it's so important because these characteristics you will see time and again when you're looking at accounting standards in the rest of this course. Advantages to a conceptual framework versus rules. So the advantages are that accounting standards are developed on the same principles using a consistent approach. So it's nice to have something to draw on. The development of accounting standards less subject to political pressure, especially when we're using global standards, and avoids the need for a large volume of rules for every single given situation. We can apply the spirit of the rules, the principles if needed. The disadvantages then, it's not clear that a single conceptual framework will suit everybody. May need a variety of accounting standards, perhaps for smaller entities and larger entities and different global entities. And that's why there's not just one accounting standard. That's why different countries have different standards that they draw on. It's not clear that a conceptual framework makes the task of preparing and then implementing standards any easier than without a framework, which can be argued. So being aware of those advantages and disadvantages if you had to see them in a question. The IASB's conceptual framework, so the International Accounting Standards Board, that's the one that we're looking at. They're used to help develop IFRS, but remember they are not an IFRS. If there is no IFRS for something, if there's a new emerging topic coming out in the real world, lots of online digital assets, for example, then how you would account for those is you would use the spirit of the conceptual framework as part of that discussion. The contents of the IASB conceptual framework we're going to see in the summary, so we're going to look at each of these in turn. The first one being the objective of general purpose financial reporting in this next column. The objective of financial reporting is to provide financial information about the entity that is useful to existing and potential investors, lenders and other creditors in making decisions. It helps the users make decisions. A couple of principles within here that are key and you'll see used throughout the accounting treatment is the accruals basis, that we recognise accounts and transactions when they happen or occur rather than when the cash is received or paid. And you're going to see that coming in your course. Going concern, that the financial statements are prepared on the assumption that the company will continue in operation for the foreseeable future, that it's not going to go bankrupt anytime soon, or at least within a year. So those are the basic objectives. Again, the contents we're going to look at in turn. The next one is the qualitative characteristics. So qualitative characteristics, we've got fundamental qualitative characteristics of relevance and faithful representation. Just got to learn these, so important. Real short form question territory. Relevance, capable of making a difference in the decisions made by users to help predict or confirm values. And they've brought in the concept of materiality here. So materiality is something that is important to users, and if it was missing or incorrect, it would change their mind, it would change the decisions of the users. So really important that we are including relevant information in the financial statements. Faithful representations are a really important one here, so that the information within the financial statements has to represent economic phenomena and has to reflect the substance of what's going on. So not always the legal form, not always what the bit of paper says, but what the underlying substance of the transaction is, and you're going to see lots of examples of that in this course as well. Financial statements must be complete, they must be neutral, unbiased, and they must be free from error. And that means they will be faithfully represented. Those are your two fundamental qualitative characteristics, so make sure you're comfortable that that's where they sit. We also have a number of enhancing qualitative characteristics. Again, you just need to learn these. You might have to list them or spot them in a short form question. Comparability, so about other entities and other periods. So we compare year on year by including two sets of financial statements side by side, but also we can compare with other entities if we know which financial accounting standards they're using, and it's easier to compare. So that's why we follow the standards. Verifiability, the information must be capable of being verified, that there's underlying documents and calculations. Timeliness, that it must be produced in good time, because if it gets produced 2 years down the line, then it's too old perhaps to make good decisions. And understandability, the information must be classified and presented in a clear and concise manner. The last bit just talks about the cost constraint, that the benefits of reporting financial information must justify the costs incurred to provide and use it. So more really important stuff here is our definition of the elements of the financial statements. Again, you're going to want to learn these elements. The definition of an asset, a present economic resource that is controlled by the entity as a result of past events. Present controlled past events. That idea of control, you don't need ownership of the asset, you just need control, and you're going to see that when you look at leases later on in this course. For us to recognise a liability is a present obligation to transfer an economic resource as a result of a past event. So something's happened, which means that we've got an obligation to pay out money, for example. That's the liability. Something that we owe, or that we owe somebody something, essentially. That obligation. And equity is really just net assets, and that's what the definition is. The residual interest in the assets of an entity after deducting all of its liabilities. Essentially, it's net assets there. We've got two other elements. We've got income and expenses. These are things that go on our profit and loss account. So income is increases in assets or decreases in liabilities that result in increases in equity. If we think about that, it's just stuff that goes into our profit and loss that ultimately comes into our reserves or our retained earnings. So income will increase our profit or loss, and that will increase our equity by increasing our retained earnings. And expenses do the opposite. They will decrease, resulting in a decrease in equity, decrease in profits, and then decreasing our retained earnings that way. So those are definitions you have to be able to spot and understand in those short form questions. So do learn them and be able to spot them. Also important is our recognition criteria. So when can we put a number in the financial statements, and when should we take it out? So recognition criteria is when we should be putting the number in, when it meets the definition of an element, when it provides information that is relevant and a faithful representation, and at a cost that does not outweigh the benefit. That's our recognition criteria. And our derecognition criteria as to when to take it out is when we've lost control of that asset. Remember, we don't have to own it, but when that control is gone, then we would derecognise an asset. We would derecognise a liability when there is no longer the obligation in respect of it. So perhaps we've repaid it, or perhaps for some reason we don't have to repay it anymore. And at that point, we would no longer be recognising a liability in our financial statements. One final bit of this chapter then is about measurement. So we have historical cost and current value. So historical cost is most common. That's where we measure at the transaction date. So for example, an asset when we acquire it, and a liability, the value that we take on at that point, less transaction costs. So that is the most commonly used one. Obviously, historical information can become out of date. We could use current value, So that is an alternative measurement basis that we can use. Information is updated to reflect changes in value at the measurement date. So perhaps if we want to revalue an asset instead of leave it at that historic cost. An example of a fair value or definition, a price that would be received to sell an asset or paid to transfer a liability in an ordinary transaction between market participants at the measurement date. So what if there was a market that existed, what price would you pay on that market would be a good estimation of a fair value. We can also use value in use. So how much can we get, for example, from an asset if we continue to use it? A way that we could calculate that would be to look at the present value of the cash flows that we would expect from the asset. So if we're expecting to use a bit of equipment for 5 years, we'd look at the cash flows coming in and discount them back to today's rate. That's the present value. So that's an example of value in use. And a similar one from a liabilities point of view would be a familiar fulfillment value. So the present value of the cash flow is expected to be obliged to transfer to fulfill a liability. So any cash flows to fulfill a liability discounted back to today's rate. So that's a value in use, and also current cost. So the cost of an equivalent asset that could be received for an equivalent liability at the measurement date as well. So all of the elements in this chapter, absolutely typical Section A, Section B type questions where you have to perhaps select one or two from a multiple choice or multiple response style question. Very knowledge based, lots of stuff just to learn. And the best way that you can do that is through lots and lots and lots of question practice to learn as much as you can about the conceptual framework.